in just a couple minutes.
We'll start in just a moment. We're going to get recording here for this. Hope everybody had a phenomenal weekend and a great Mother's Day weekend.
Likewise.
Hi, everyone.
Ian, hello from down under over there.
Yeah, man. Looking forward to seeing you guys in Florida next month. Pumped up.
Yeah, looking forward to it, man. Looking forward to finally meet you.
Yeah, man. It's going to be great. Good to meet you too, Jay. Mate, you going to be there? Oh, you're on mute, mate.
Oh, sorry, I was on mute. Yes, I'm going to be down there in Florida in June. And thanks for joining. Good seeing you here.
Awesome. No, you're welcome, guys. Great. Thank you for having me. It's 12 o'clock on, what day is it today? On Tuesday today. Yeah.
Awesome. Madoka, hello.
Hello.
Joining us from Japan over there.
Yes.
We're going international on this call.
Yeah. Looking forward to attending.
Yeah, we got New Zealand in the house. Japan's in the house. Let's wait a couple more minutes before we get started here. Wait for some folks to hop on. This call is going to get recorded. Thank you for everyone for hopping on. It's great. We're going to learn tonight. Love some feedback as well afterwards. You guys stay on for some Q&As. Madoka, what time is it over there in Japan?
It's 9 a.m. on Tuesday.
9 a.m. on Tuesday.
Yeah, it's very hot. It's over 70 degrees now.
Over here in California, it's 90 degrees outside.
Oh my God, that's too hot.
But it's dry heat. It's dry heat though. It's all right.
That was very cold 2 weeks
Hello.
ago. Yeah.
Hello.
Can you guys hear me?
Yes, we can, Luis.
Is there anything wrong with my mic? Do you hear any noise? Anything that's
No, you're
distorted?
super clear.
Okay, cool.
Loud and clear.
How you guys doing?
Good. Thanks for
Great.
joining, Louis.
No problem, man. I was waiting for this.
Great. Good to have you on.
How you guys been?
Good. Just trying to stay busy like everybody else.
Yes, definitely.
Excellent. I think we are about 4 minutes over.
What do you think, Jay? You think we should get started?
I think we should get going, Alex. Yes.
All right. Okay. Well, thank you everyone for showing up. You know, a lot of you are friends and family, and our group is the Compounding Capital Group. And tonight we're going to really talk about real estate, dive into why real estate investing is one of the key vehicles and why it should be in one of your investment portfolios. But before we dive in, I got to go through a disclaimer, all right? Because we will go through certain numbers that we've done, but before we go through all of that, and it's what we've done in the past and what we have shown to be true before you say, hey, I thought you guys promised this number or that number. Make sure you still go through it with your CPA, because tonight we're going through why real estate is a good vehicle and how it can create generational wealth. So I'm going to go through this disclaimer here. The strategies mentioned in this presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountants, tax advisors, and attorneys to discuss your specific situation. Past performance is not a guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. So who we are. Jay, you want to take over from here, introduce yourself?
Sure. Thanks, Alex. Great to be here. Thank you all for joining this evening on a Monday. My name's Jay. Real name is Jaydeep. Jay is a lot easier to pronounce. I have roots in technology and cybersecurity consulting. I've been with Deloitte for about 10 years and recently left my W-2 in January of this year. I've been investing in real estate since late 2019, right when about COVID happened. And I know COVID was a very unfortunate event for a lot of people, but it was a blessing in disguise for me because I discovered this investment vehicle that eventually got me to financial freedom. Now I currently focus on multifamily real estate, cash flowing real estate, usually heavy distressed value add type of deals. Mostly in Cincinnati, MSA, south of Dayton, and also in other parts of Midwest like Indianapolis, Columbus area. So that's kind of my specialty. And my partner here, Jason, is not able to be on the call today, but he also comes from a corporate background, an ex-data scientist, and now a full-time real estate investor as well. And he mainly focuses on underwriting on our team and also parts of asset management. Alex, over to you.
Yeah, so Alex Tam over here. I joined the CCG team this year, brought on as investor relations. My background is I've had my medical office for the last 14 years. I've been investing as a limited partner since 2018 and actively now on the general partnership side, which we're going to dive deep on what that really means since 2021. My goal was initially knowing that having a practice and a business, if I'm not there, then we don't make any money. We do have a great system at the business, but I want to enjoy some passive income. And some people say, hey, let your money make some babies, right? Financial independence is something that my wife and I have strived to achieve. And I have achieved that in 2022. So now I spend a lot of time showing other business owner, other doctors, what we've been able to do so you don't feel like you're always in a rat race overall. So going to the next page here. Now, why real estate, right? Franklin D. Roosevelt, this is his quote: real estate cannot be lost or stolen, nor can it be carried away. Purchase with common sense, paid for in full, and managed with reasonable case. It is about the safest investment in the world. So if we were to dive in, why we need to, who's seen this? I mean, for those of you who've seen it, it's called the cash flow quadrant, right? Robert Kiyosaki made this quadrant very popular, where at the top left, you have the employee, which means that you own a job. You have a job. You don't really own it. You have a job. Self-employed is where you own a job. About 70% of businesses in the US are solopreneurs. So most of us get trapped right here and you don't hire anyone. This side on the left quadrant is where you get taxed the most. That is our biggest expense, right? When we ask business owners, hey, what's your highest expense? People will say, oh, it's the people, it's the payroll, it's one or the other. No, it's taxes. If you're on the left side of the quadrant, you will get taxed very heavily. On the right side of the quadrant is where you will get taxed very little, close to zero on the bottom. Right? We hear real estate investors, how come guys in real estate don't pay taxes? Or, right, you've probably heard Warren Buffett pay less taxes than his assistant does. When you move from the S to the B and become a business owner, you now own a system that works for you. But now you make money here, you got to put it in here because this is where your money works for you, right? By a show of hands, who would like to be in the investor? A lot of us would, right? A lot of us would, right? All of our hands should be going up, okay? Now, when we look at this, this is from CNBC, the 7 levels of financial freedom. What are the 7 levels? If you go from the bottom up, first it's clarity, okay? You figured out where you are financially and where you want to go. Some of us are here. Self-sufficiency, level 2. You move out of moms and dads and can cover your expenses. Hope most of us are here. Number 3, breathing room. You're saving some money. You're no longer living paycheck to paycheck, right? About 83% of Americans, between 75 and 83%, live paycheck to paycheck. So most Americans are stuck between 3, 2, and 1. Now you move in the level 4, stability. You have no bad debt and you have 6 months worth of expenses for emergencies. Okay. Number 5, flexibility. You have at least 2 years of expenses saved. You could take a year off work and you'll be okay. Number 6 is where last year, and a lot of the business owners, investors I talk to want to get to, financial independence. You can live off the income your investments generate. What that means is, and a lot of people ask me, well, how do I know? Well, you look at the last 6 months of expenses, average it out. What's your monthly income? And then you have to look, well, that's your monthly income. If your passive income can generate that every single month, you're now financially independent. Number 7, abundant wealth, right? I'm sure that most of us want to strive for that where money isn't a concern. You have more than you can ever need. Now, why real estate? Real estate for us is because we chose it. It's a hard asset. It's something that you can see, touch, you know what's there, versus something in paper, right? All of us in the last 6 months to 12 months have seen the roller coasters of the market, whether you're in the crypto market, currency market, or the stock market. So when you look at real estate, number 1, real estate's able to generate passive income. Number 2, it's one of the best investments that will hedge against during the recession, against inflation. Number 3, there's a lot of tax benefits, huge amount of tax benefits. That's why a lot of real estate investors don't pay taxes. Preserve capital, right? The biggest thing that we do at CCG, Compounding Capital Group, is help you preserve your capital. That's our number 1 value because you've worked hard for your money. Our goal is to help you preserve it, but also we force appreciation. What does that mean? That means when we go in, we're able to increase rents, increase operations, and you force the appreciation up. As rents go up, you automatically appreciate the real estate, all right? Especially multifamily real estate. We're not abide by school areas, locations, right? So we're really looking at how much rents can go up.
Awesome.
So
Alex, on
go
the
ahead.
slide, on that slide, I would like to kind of double click on each one of these 5. So when we say generate passive income, what does that mean? It's essentially income collected from rents. So while you're still busy working your W-2 or in your self-employed job or running your business, the rental income keeps coming in. So of course, real estate is not completely passive. Someone has to be actively managing the asset. And that's where we come in. We actively manage the asset in coordination, in conjunction with our property managers, construction guys, so that our investors can actually passively generate some income. And that is primarily coming in from rents, right? So that's what we mean by passive income. 2, what Alex mentioned about resilience against recessions or a hedge against inflation. Why is real estate a hedge against inflation? Because most of the other assets that you have, with inflation, their value is not necessarily going up, right? Our savings interest rate is pretty abysmal. So most of the assets are not going up in value as the inflation continues to go up in numbers. But with real estate, especially rental real estate, your rents are going up as the inflation goes up. And that's why it's a really good hedge against inflation. And the second aspect of it is your leverage, which is your loan mortgage against real estate, is locked up at a fixed rate of interest for 7, 10, 20, 30 years. So your interest rate is fixed, but your rents are going up with inflation. So that delta, you're really capturing that appreciation play there. And that's why it's a really good hedge against inflation. No other asset class can give you that. Government is not going to give you loans at, used to be 2 point some percent. Now it's 6 point some percent, but still government is not going to give you loans to buy stocks or buy cryptocurrency, but government is going to give you loans to buy real estate, and up to 80 to 85% of it can be leveraged. So that's leverage is a huge benefit with real estate as well. Tax benefits, we will be double diving on that in our next webinar as well. But tax benefits is mainly, why do we get these tax benefits? And Alex talked about the cash flow quadrant. The right side of the cash flow quadrants gets these tax benefits for two reasons. Business owners create jobs and real estate investors create housing. And housing and jobs create the most amount of value in a market, in an economy. And that's why the IRS blesses us with less taxes. Then we have preservation of capital. Alex touched upon this, that tangible assets that you can feel, touch, it's never going to disappear. With cryptocurrencies, stuff like Dogecoin or any type of meme coins, or even with stocks, if the company is not operated well, if it's a smaller company, your capital can evaporate, with what happened with Theranos, for example, right? So when the company goes out of business, your capital or invested capital evaporates with it. But with real estate, with market cycles, it will go up and down. We are not saying that your invested capital is always going to go in one direction, which is up, but over a long enough time frame, it's going to preserve the capital, and over long enough time frame, it's going to go up as the market recovers. So you just have to be patient enough, and in the meantime, collect cash flow from rents. And finally, forced appreciation. Again, this is something we will touch upon even more in detail in our multifamily webinar coming up next. But what we mean by forced appreciation is, and this is not general to real estate, it's more specific to commercial real estate, because commercial real estate is treated like a business. It's not treated like your single family home, where the value of your home depends on comps. So if your neighbor's home sells for 500K, your other neighbor's home sells for 400, the value of your home is an average of those two numbers. That's how single family homes are valued. But with multifamily real estate, the value is created, or the appraised value of the asset is based on the net operating income. And that is exactly how businesses are valued. So it's valued like a business. So the more NOI you create, you reduce your expenses, you increase your income, you have effectively created value. It's very difficult to create value in any other asset class, because you have no control over the value of your Bitcoin. You have no control over the value of the stocks you own. You cannot do anything to increase or reduce the value. But we real estate investors, through better operations, can improve the value of our assets. And that's what's forced appreciation. So I hope this is helpful, but we will be covering all of these aspects in our next webinar, even more in detail. So.
And Jay, I like how you touched base on how banks wouldn't loan you money to buy stocks. Heck, you walk into Wells Fargo and you say, hey, I want $100,000 to invest in the Wells Fargo stock. They wouldn't even loan you money, let alone any other stocks. But yet they'll loan you money 60, 70, 80% to purchase a multifamily or any commercial building. So why multifamily? Like Jay said, we're going to have a separate multifamily. This is Today we're going to talk about real estate. On the next webinar, we're going to actually take a deep dive, an even deeper dive into multifamily. But when you look at why multifamily, starting from the bottom left, as we own the asset, we're paying down the mortgage, right? Just like a single family, you're paying down the mortgage as time goes on. You have that passive income cash flow. Now, multifamily is a human need, right? We all need food, we all need shelter, we need clothes on our backs, and it's a basic human need. What Jay touched up on is that strategic force appreciation. We hedge against inflation. And then of course, there is the tax benefits that goes along with it as well. Jay, you want to add any pieces on this one?
No, I think some of this we touched upon on our last slide as well. And important thing to note on mortgage pay down is technically you're not paying the mortgage, your tenants are, right?
That's right.
So from the rents we collect, a big portion of that goes towards mortgage pay down. A portion of that goes towards maintaining the assets, so expenses, and what's left over after all expenses are paid and the reserves are maintained is the cash flow that we all investors get to enjoy. So.
Awesome, awesome. Well, if we look at the history of rentals, so why is it that in real estate, when you invest in real estate, you look at the home ownership from 2005 to 2019, home ownership has actually gone down. You talk to a lot of millennials, Gen Y and Z, a lot of them don't want to necessarily own a home, nor some of them can they afford to own a home. So a lot of them actually started renting. You look at 31 to 35%, that's over 15% increase over this period of time. And on top of that, the supply in the 80s, 90s, and 2000s, and the 2010s, supply has gone up, but has significantly gone down in the last decade or so. And that's why we feel that really real estate, due to the shortage and supply, you got the supply and demand, rents continue to climb. Now, our strategy. So a lot of people ask us, well, how do you do it? What do you just look for any apartment, just end up buying it? No, it's not like that. It's very, very strategic. So first you have to analyze the market. Does the market have a growing population? Are there companies that are growing in that area? Are there people moving to that area? Or are there people moving out? We analyze the market first. Then we find value add properties. That's what we focus on. We focus on finding properties that we can add value to it. Maybe it's poor management, right? Someone might have owned the property for a long time and they just could care less about it. So we can go in, let's touch up, paint, add different amenities to the property, make it safe, affordable, and clean for everyone to live in. Then we, once we find those properties that meet our criteria, our buy right criteria, we make an offer, we negotiate, and then we get financing. This piece is actually a huge piece. It's completely different than buying a single family home, right? When you look at a commercial property, you actually have to make the offer, and then you go back and forth between your attorney, their attorney, you negotiate. And the financing is not just, oh, I'm going to pick a bank, right? Get the good rates. We have to make relationships with a lot of these banks. Go bank to bank, right? Shop the rates. They sometimes can even change up the offer on us. And once everything is done in step 3, step 4 is the inspection due diligence. If you have a 200 unit property, you're walking every single unit. You're getting on top of the roof, looking down the chimney. You're scoping the plumbing, right? You're checking the HVACs. Everything has to be done. This is usually, would you say, Jay, like a 1 to 2 week process?
Absolutely.
Just the due diligence.
About a 2-week process, sometimes 3. And it's the physical side of things, as Alex mentioned, the physical walkthrough. We make sure to walk every single unit. So every operator is different. Sometimes people sample a selection of units that they walk, but we walk every single unit of the asset that we are about to buy. Why? Because we really need to know what we are buying. Because if we don't know what we are buying, how can we protect our investor capital? So that's the physical side of it. But the due diligence has another aspect of it, which is all the documentation review. So if we are buying a 200 unit apartment complex, we review every single lease that's in place. We don't want to inherit an asset, let's say that has 10-year leases on apartments and we cannot push the rents because the lease is locked up for 10 years. We have never seen that, but just as an example. Similarly, we will review all the income items. What are the expense line items? Utility bills, common area maintenance. Where are we overspending? Where are the money pits for the assets, if you will? So there is almost a 40 line item due diligence checklist that we go through during this phase. And that's why this whole process takes 3 weeks to a month sometimes, depending on the size of the asset. Yeah.
Absolutely. And then the fifth step is where we will actually go. Going back to, let's see, the fifth step over here, manage and improve the asset. Now that we have purchased the asset, we have to execute our business plan. How do we manage? How do we improve? And the properties that we have construction crews. Jay, you've got, is it three construction crews that we have here, right?
Currently, we have 3 construction crews in-house, about 15 people. And essentially improving the asset is the portion where we actually start working on our value add properties that we found in step 2. Because in step 2, when we say find value add properties, for people who are familiar with buying businesses or even buying hotels or any other asset class, when you buy something, you need to make sure that there is an opportunity to improve the operations and improve the asset, because that's where you're creating that force appreciation. So those are the types of assets that we try to find. And in that second to last step, that's where we actually start adding the value through renovations, construction, but not only that, through operational efficiency too. We look into every single expense line item to see where we can cut costs. Can we cut costs on trivial things that may sound very trivial, like a cost for one dumpster, may seem like $300 a month, but if we can save $100 there and find a few other line items like that, it does add up. And by the end of the day, you are increasing your NOI, and only a $5,000 NOI increase can increase the asset value by hundreds of thousands of dollars. Something we'll touch upon in our next webinar too. But that is all a part of managing and improving the asset. So physical improvements and operational improvements.
Yeah, I mean, that piece is huge, because everything can go right up to this point, but if operators do not know how to manage a property, really you manage it like a business. In any business, if you overspend on, say, marketing, right, it's unnecessary, and that's going to really bite into your NOI, the net operating income. And then lastly, once everything is well, we push the rents, the asset gets reevaluated and it gets sold. Usually, would you say the whole time, Jay, is about that 5 to 7 year? Is that sweet spot right there?
Exactly, 5 to 7 years.
Yeah. And once it's liquidated, then the profits are then distributed among the investors and the operators. So what is a syndication? To go over the definition of a syndication is a group of investors who pool their resources, time, knowledge, money to buy a large asset and share the profits, right? There's 2 investor types. You have the active investors, the general partners, that's what we do, right? Where we provide the capital, the time, the experience, the network needed to identify, buy, and stabilize, manage the property. And then there is the passive investors, limited partners, right? Provide the capital required to purchase the property. If you look back at this first phase right here, between here all the way to here is what we do as active investors, the GP side. Once we purchase the property, this is where the limited partners come in, because it does require capital to purchase the property. And really, then there's not much to it after that. We're able to operate and then liquidate afterwards. Anything you'd like to add to this, Jay?
No, not on this slide. I think the next slide, we also have about syndication and what it really means. And This is basically drawing parallels between a real estate syndication model, which by the way is SEC approved model. So when we talk about syndications and buying a property with a syndication model, you are actually protected by SEC regulations, right? So SEC 506B and 506C regulation D is the name of the SEC regulation. So how does it compare with a company, a corporation, corporation like Tesla or any other publicly traded company, right? So in a company, we have C-suite or senior leadership board of directors. Most of the times they have a stake in the company, ownership stake, but they're also taking all the key management decisions, right? And that is very similar to the general partners on the syndication side. So general partners have equity in the asset. Most times they also invest their own personal capital in the deal so that they have skin in the game, and they are making the key decisions, when to refinance, the key financial decisions, how to improve the asset, when to renovate, when not to renovate, right? Things like that. The investors for the company, which is basically the shareholders, people like you and I, when we buy Tesla stock, all we do is we give the money to Tesla, we have the small ownership, but we have no decision-making powers, if you will. So that is almost similar to the limited partners. So limited partners are still part of the deal. They have the equity in the deal, but they don't have the daily, day-to-day decision-making powers. So that's why limited partners are also called as passive investors, because similar to Tesla shareholder, you don't have responsibilities. You just invest into a deal and collect the cash flow, right? And finally, we have the employees of a company who do the day-to-day operations and execute on the day-to-day tasks that the company has to operate on. And similarly, in a real estate syndications, we have vendors, property managers, our partners, contractors, construction crew. They are almost like our employees. Some of them are employees, some of them are subcontractors and 1099, but drawing the parallel, that's the third piece. So they actually get the work done, right? So that's really the parallel between the syndication model versus a typical publicly traded company, if that's helpful.
And Jay, as a limited partner, how are the limited partners supposed to know what's actually happening? What's the communication like?
Yes, so again, drawing parallels, shareholders get an annual report, a shareholders report from a company, right? So similar to that, we also release quarterly reports. So these reports come out in the form, usually in a form of an email, where we provide updates on, in the last quarter, what was the financial performance of the property and what was the operational performance of the property? What were the improvements that were made? So usually the detail that you get here is going to be way more detail than you would get when you invest in a stock for a company. So when you invest in a stock, you get high-level information, high-level financial information, but you don't really know what is Elon Musk doing sitting in his office and what are the day-to-day decisions he's making. But in a real estate transaction, because it's a relatively smaller deal, you are way more actively involved and engaged throughout the process. So you get to see the pictures, the improvements that were made. And in addition to that, the P&L, the income statement, the operating expenses, the expense statement. So you get access to the financials as well. But you do get access to that on a quarterly basis. So that is essentially the reporting piece.
And that is one of the other values that we have, core values, is transparency. We want to make sure that we're completely transparent to our investors and show you the P&Ls. So you understand, hey, where your money is going. It's not me and Jay partying, somewhere remotely. You get to see where every dollar is actually spent on the property. And that's where we believe transparency is huge. Syndication responsibilities, another quick look at it, where limited partners, you're putting money into an LLC. The LLC is then what is funding the property. And as general partners, we put money into the LLC as well, and we have the control over the LLC. And that's why when you look at these factors on the right side, the risk for general partners is actually really, really high because we are the ones that are backing the loan, right? They're looking at all of our financials to make sure we have the capability to take on this property. Whereas limited partners, you're very limited to the investments that you make. And they're not going after your assets. If something were to happen to the property, they're coming after us as general partners, not you. Time commitment. The steps that we've laid out earlier, the first 4 steps are all done by us. And the time commitment from you is attending a call, making sure that this is the right investment for you, and then funding the money that you like to invest. Capital, less on the GP side, heavier on the LP side. I understand running a business. A lot of times it's either time or money. We put the time in, investors put the money in. We have money in the game as well. It's just not as much as the limited partners. Tax benefits. We both get tax benefits from this, and we'll cover a lot more of this in the multifamily side. But essentially, everything that you are getting on a passive income during the month is wiped out tax-wise due to the amount of depreciation that you get from the specific asset. Control, once again, just like we showcase here, we have control, the GPs have control of what's going on, LPs have less control. And the profits, when you come down to the whole exit plan of the profits, when we liquidate the asset, LPs get most of the profits from here. Jay, how does that sound? Anything you'd like to add here?
No, I think that was perfect. So,
All right. So let's go over some market trends. This is market data that we have put together. And this is very, very current data. If I am not mistaken, this just came out in April 27th from apartments.com, where it looked at the amount of supply forecasts in the coming metros. When you look at from Phoenix, Austin, all the way to Cincinnati, and we focus heavily in Cincinnati and Northern Kentucky. And when we see this, what that means is these are the units in 2023, the amount of units that is going to be delivered, which means that there are brand new units hitting the market this year. As you can see from Phoenix and Austin, Atlanta, you have 16,000, close to almost 20,000. In Cincinnati, this metro here, Palm Beach, Cincinnati, very, very low, just 4,000 apartments. Now, the reason why this is important is because when you have higher amounts of multifamily hitting the market at the same time, what it does is that it prevents operators and owners and investors from driving rents as much, because it's almost as if brand new ones are coming in so quickly. Well, how are you supposed to raise the rents on certain ones? You got to pay attention to what's actually happening in this forecast here. That's why the supply and demand is so important. Looking at the rent growth across the US, this is from apartments.com, looking at the rent growth from March of 2022 to March of 2023. And it highlights that this is what's actually happening. You have Indianapolis, Cincinnati, Columbus, all Ohio or near Ohio, right? St. Louis, Jersey in the 4s all the way up to 6.6. But there's also in the market trends where San Francisco, Austin, Las Vegas, and Phoenix, rents have actually gone down in some of the markets. So this is something that you need to pay attention to in real estate. Now, rent growth factors, what is this forecasting? The blue line on here, the light blue line, is forecasting the 5-year average before COVID of rent growth. So San Diego, Northern New Jersey, you're seeing where they were before COVID. And 2023 forecast by apartments.com, this is where the same cities are going to be in 2023. And as you can see, there's not very many cities and metros that in 2023 will actually meet the 5-year average. You have the top 7 to 8 that's going to meet it right over here. couple down here, but most from here to here and all the way Boston, San Francisco, LA, and everything on the right side will not meet the pre-COVID 5-year average due to the amount of inflations in the area, the amount of going back to how many apartments are coming in to that area. That supply and demand plays a role. Jay, what else do you think plays a role in the rent growth forecast here?
Yeah, supply demand is primary driver, and of course the cost of capital or interest rates. But I think why are Midwestern markets shining now, right? So in the last 2 to 3 years, we've seen actually almost last decade, the Sunbelt markets was where it was at. The thing is with coastal markets and Sunbelt markets, I would love to rephrase a quote that one of the other real estate investor posted on their LinkedIn profile. And it was like, when the coasts are experiencing an ocean surge, the Midwest is experiencing more of a wave pool, right? And that's very true. The Midwestern markets, and we can already see it from all of these charts, Indianapolis, Kansas City, Cincinnati, Columbus, even Dayton, right? These markets are very stable. So the upswing and the downswing, they're both relatively low. So your risk is padded quite well. So you're not seeing those 25% rent growths, but you're not seeing that crazy -5 and -10% cost reduction or price reduction either. So these are more or less stable cash flowing markets. And we also look at not just the overall rent growth or appreciation, but also cash flow. So what is your cost of entry, right? So if we are looking at our total replacement cost, what that means is, what is the cost to build a new apartment today? It's roughly about $250,000, as opposed to what can we buy that apartment for? In the Midwest, we can still buy that apartment for roughly about $100,000, while the replacement cost is $250,000. Same thing in Phoenix is $350K. So you're actually paying more than replacement. So that's why there are some risks with overpaying in some of these hotter markets, because you never know when the music with this musical chair is going to stop. And the signs are showing that the music is about to stop as the cost of capital is going up. So there are multiple aspects to look at: cost of capital, population influx, job diversity, right? So in Indianapolis, Columbus, Cincinnati, we have so many Fortune 500 companies across all industries. So we look at all of these different trends, and that's why looking at this data is extremely important. And then finally, your supply and demand. Now we know that, the supply with multifamily units is at an all-time high, but most of that supply is going to Phoenix, Dallas, Houston, some of these markets. Why is that? Because cost of construction is $250K per door average, but the rents in those markets are $2,500 to $3,000. So it makes sense to build more units in those markets, while the supply in Midwestern markets is new supply, I should say, is low because the rents are $1,200, $1,300, $1,500 tops, right? So it doesn't make sense to build here. And that's why there's a shortage of supply, but an increase in demand. So that's always a really good time to invest in a market, when there is demand that's going up, but the supply is limited and going down. So yeah.
That's a great explanation, Jay. Thank you. Now, market insights. Jay, tell us about this actually. You definitely have the insights on where the expansion, hypersupply, recession, and recovery is.
Absolutely. So this is another data point that we look at. A lot of real estate investors look at this data point. This comes from IRR. And who is IRR? IRR is a data company very similar to CoStar, but what they really do is, when you do commercial real estate appraisals, this is the company that does most amount of appraisals in the US. So they know exactly what the properties are trading for, what are the cap rates. And cap rates, we will be talking a little bit more about those in our next webinar. Cap rate is a metric that is completely market dependent. So healthier cap rates indicate healthier market, and decompressing cap rates means the market is not doing as well. So in this chart, IRR puts together, based on rent growth, sales price, and cap rates in each market, they put together these markets in what they call is the market cycle, right? So we have the recession, recovery, expansion, and hypersupply. And usually the best time to enter a market is during the recovery and expansion phase, because that's when the rents are going up, people are moving in, and the properties are on their upward trajectory. So we see a lot of these Midwestern cities, including Columbus, Cincinnati, Dayton, Ohio, parts of Kentucky as well. They're all in the expansion phase, if you will. While if we look at some of the Sunbelt markets that are beginning to get into that oversupply phase, Houston, Phoenix, Arizona, some of the Florida markets like Sarasota. So usually when you are entering a market, when it's in hyper supply, the risk is you have way too much competition coming your way, and you may not be able to increase the rents based on your pro forma or your projected returns. So I think those two things are really important to look out for, but this is not a one size fits all formula. So even if you buy something in a hyper supply or recession market, but get a really good deal, so you're paying something for the property that is way under the appraised value, I would say it is still worth considering, but it's always a good idea to go into a market while that market is in the recovery and expansion phase, so that you can ride that upward wave and not only capitalize on the force appreciation you create through better operations, but you also ride that market wave as the market itself is going up.
Hmm.
So
Thank
hope
you for sharing that,
that
Jay.
makes sense. Yep.
All right, well, let's go over, Jay, here's some case studies that we've done. Let's take a look at
Great.
that.
Perfect. Sounds good. We'll try to keep our case studies relatively high level and short, as we will be covering some of our case studies on our next call on multifamily as well. But this is one of our properties that we closed on last year, 36 units in Miamisburg, which is on the Cincinnati-Dayton expansion corridor. So this corridor is seeing a lot of growth as a lot of high-skill manufacturing is coming back to the US. During COVID times, we realized that our over-reliance on supply chain on China was causing a lot of problems. And that's why a lot of this chipset manufacturing, lithium-ion batteries manufacturing, even automotive manufacturing like engines. So Honda has a plant here. So this is a high growth area, and we bought this asset on this high growth area last year for about $70,000 a door. And this is the picture of this asset. So you can clearly see it was a dated looking asset, needed a lot of work, but the location was great, close to hospitals, schools, shopping malls, Whole Foods. So we look at all of those things in terms of location. And then we also look at amenities, are there covered carports, central heating and cooling, washer dryer hookups, individual water heaters, things like that. So, and all 2-bedroom units. Why does that matter? Because in 2-bedroom units, people tend to stay longer. They don't, because people live with their families in 2- and 3-bedroom apartment units. So that's why it was a really good asset to pursue. So we bought this last year, like I said, for about 72 a door. And then going on to the next slide, these are some of the pictures of how that asset looked like when we bought it. And some of you on this call have gotten a chance to tour this asset with us during the meetup that we did here in Cincinnati. But this is really how the asset looked like. So definitely needed some love, was not in the best shape. And this is what the asset looks like now. So we have renovated about 17 out of 36 units that were especially in poor shape. Some of the other units were already partially renovated. So we continue to bump up rents on those units. And we completely rebranded the property, transformed the exteriors. Now we are doing the spring cleanup and landscaping, but that's what the asset looks like now. So not only does it look prettier, the tenant base has completely changed. Some of the problem tenants we had, people who were breaking into each other's apartments, a little bit of crime that was on the property, all of that is gone. We have one cop who has moved in. That has cut down the crime levels significantly. We have added security cameras and exterior lighting for public safety. And now it's a completely different asset. Within 1 year of operating this asset, our rents have gone up by over 20%. So huge influx of NOI. And in just 1 year, the property value has gone up by $1 million. And in our next webinar, we'll actually share some examples of how increasing the NOI affects the property value based on the market cap rate. But a 1 million increase in value in just about 1 year It's pretty incredible just through force appreciation. Okay. And then this is another case study, which is actually almost 3 years old. And I like to talk about this case study because on this one, we've almost gone full cycle where it has been completely renovated. The rents have gone up and it has been refinanced into new debt structure. This was how the asset looked like. Again, pretty dated property, a lot of problems with the tenant base, drug dealers, prostitution, a lot of crime, you name it. We still get letters with warrants from the police department for the tenants who used to live in this property. Okay. So it was not easy. Letting all of these tenants go, we ended up on the news channel because of that. So it's definitely not easy. So a lot of people think that, oh, you just buy properties, renovate them, and then, yeah, you enjoy the cash flows. It's a lot easier said than done. But this was a 1-year project to get the existing people out. And again, it's not about ruthlessly kicking people out. We gave them 3 months and we found them alternative affordable housing. So we worked with other real estate investors in the city who focus on affordable housing. And we found our tenants alternative housing and gave them 3 months to relocate and paid 50% of their moving expenses. So sure, these numbers will tell you that this is an incredibly profitable property, but it doesn't mean that you have to be ruthless and heartless and just kick everybody out, get new people in and increase rents. So you can make a lot of money in real estate. At the same time, you can do good. Now, even though we did all of this, our tenants still are unhappy, our old tenants, because they had to leave their apartments. But you can do the best you can so that you're working with people, you're finding them alternative housing. But on the left side, the numbers tell the complete story, right? It's an older asset, 65 construction, but built like a tank, solid concrete foundation, concrete slabs, brick exterior, only 10 apartments, all 2-bedroom apartments bought for $47,000 per apartment. Yes, that's unheard of. You can buy apartments for 47 a door now, but 4 years
3
ago,
years ago.
4 years ago, you could, yes. $200,000 was the renovation cost, all in all, exterior and interior, so about $20,000 per apartment. Rents going in about $550 per door, and the rents currently are $1,250 base rents plus $150 for utilities, internet, and other facilities we provide. So $1,400. So we've more than doubled the rents, and the purchase price of the property $470 plus $200 for renovations. So all in all, $670K. The property appraised for $1.45 million after 1 year of renovations. So you can just see that it more than doubled in value. So that's where you can truly create value. You cannot create this type of value in any other asset class, or at least not certainly, right? Your Bitcoin can double in value, but it can come crashing down. You have no control over it. Here, you can actually improve the asset, improve the operations, and based on your new NOI, your asset appraises for way more. And now the cash flow that this asset generates after refinancing, and what refinancing means is now we have a new loan on the property, which is based on the $1.4 million appraised value. So higher mortgage, but still the asset performs and cash flows at $5,000 a month. That's $500 per apartment in net cash flow. So just this one asset can replace a pretty good chunk of your post-tax W-2 income. So that's really the power of real estate. You buy 3 of these assets and you've bought yourself out of a job, right? You're completely financially independent. Because I think for most people would agree, for 15 grand a month, you can live a pretty comfortable life. And then cash on cash return is about 30% and infinite after the rehab or after the refi. Why is it infinite? Because after the cash out refi, we pulled out all the capital that we had invested in the deal. So now our capital invested in this deal is $0 and it still pays us $5,000 a month, which is why it's an infinite return deal. And I don't know any other asset class where you can get.
I was just going to say that. I
on your
don't know
capital.
anything else, any business, right, or asset class where you're able to have that type of returns over a 1-year period.
Exactly.
Yeah. So let's talk about, why. Why do we do this, right? For me, it's really simple. when I had our daughter, we had our daughter, she's 10 years old now. And we think about generational wealth. How do we spend more time with our family, right? Spend more time taking trips. And I never grew up knowing that we should invest. That, wow, that's how the wealthy does it, right? And I don't know about any of you, if any of you guys were taught by your families, but I was not. And once I knew about it and knew about the tax savings, the appreciation, the income, the cash flow, that it's possible. I always thought it was like a unicorn, right? That, oh, you know, people who just sit at home and get mailbox money, that's just BS, right? You got to work hard. You just grind until you're 65 and you hope you have some savings. At least that's how my folks lived. But once we figured it out, friends started asking us what to do. And initially I said, you know, I was just a limited partner, just like a lot of you are on the call. Eventually I said, you know what? If I'm going to tell my friends what to do, I need to become active in this. I'm not saying all of you have to be active, right? But you need to get started. Standing on the sidelines was like the worst thing you can do. Because if you buy right, if you trust people who can buy right, manage it, and exit, anytime is a great time to buy. What do you think, Jay? What's your why, Jay?
Absolutely. I think the why is same. It's family first and foremost. And I think the biggest game changer for me was Rich Dad Poor Dad by Robert Kiyosaki. Because again, I was raised in a good family, great parents, but in working class, right? So that's exactly what I was taught. You have to work hard. You have to work long hours. You have to put in the work. And my dad retired at 63. But one thing I've noticed that today my dad is relatively comfortable financially only because of real estate, because he made some real estate investments while he was in his job, right? And two, after reading the Rich Dad Poor Dad book, I truly understood the difference between assets versus liabilities. So when we are working hard, what we are doing is we are collecting that paycheck and then paying for our liabilities. While what are the rich and affluent people are doing is they're actually taking the income or the cash flow they make and they keep reinvesting that money in cash flowing assets. And once you do that, your money starts to make you more money. And then finally, that's when you truly realize your why is controlling your time. And time is your most important resource. Everybody has the same amount of time. It's the most valuable resource. And if you can buy back your time, there's nothing better than that. So if you can buy back your time, what does that mean? More time with family, more time with your kids, going to their soccer games, right? Coaching kids with baseball practice, more time with my parents, taking more vacations with the family. And you don't need to, be lazy and take vacations. You put in the work now, buy the assets pay for your liabilities and your lifestyle, so that's our why. And especially after we realized it, it was a big aha moment for us, and we just fell in love with this whole process. And that's why Alex, myself, and Jason do what we do, so we want to spread the message and see if we can help as many people in our friends and family as possible.
Right. And that's also why during this first real estate webinar, we've already scheduled our second, why multifamily? Within all the commercial real estate, why are we choosing multifamily? So mark your calendars, a newsletter, emails, you guys will be getting first dibs on this webinar. It's going to be Monday, June 26th, same time, 8 p.m. Eastern, 5 p.m. Pacific. This next page, I want to thank you all for joining us here. And here's our contact information. Whip out your phones, take a picture of it. We're available on the Calendly. You can call us, text us. We're on LinkedIn, Facebook. Drop us a message anywhere, and we'll try to reply within about 12 hours of getting those messages. Now that we've presented the whole webinar, we love to take in some questions. raise your hand if you have questions, and then we will call on you guys individually. All right, Shri. Let's go with Shri first.
Hey, Jay and Alex, my name is Shri from Pacific. So I work in a stone distribution business. We based out of Cincinnati. Our headquarters is in Chicago. So I just want to understand how important for you guys, for the investors like you are managing the properties, to save money on countertops. Because I feel that countertops are the biggest part of the house, which add more value than any other piece in the house. So how important is it for you to save money on the countertops?
The short way of answering that question, Shri, and thank you for the question. I would love to connect with you offline as well, because we replace a lot of countertops every year. I would say that every investment we make, may it be countertops, tiles, flooring, any improvement on the asset, we track the ROI of every improvement that we make. So if it's a Class A apartment community in a neighborhood that has an average household income of 150K plus, and the affordability is very high, then yes, then we will go with fancy stuff, and saving too much on the countertop may not be that big of a priority, right? But if we are renovating a Class C asset, the ROI on a granite countertop is next to nothing. So that's where we'll go with Formica or something, right? So I hope that answers your question. So saving money on countertops or any other improvement or upgrade, if you will, truly depends on where the asset is located, what type of asset it is, what is our target client base or tenant base, and what is the ROI on that improvement. By the end of the day, we are very numbers driven, and all these decisions that we make is based on the projected ROI on every investment we make.
Okay, I understood the question. Thank you.
Yeah.
Thank you.
Thank you, Shri.
And Luis.
Hey, can you guys hear me?
Yes.
Sorry about that. So my question sort of relates to being a beginner in real estate. So how would you recommend someone to actually step into this with a great foundation? You know, not necessarily, well, safely, you know what I mean? So I'm sort of a late bloomer when it comes to stepping into this sort of, you know, real estate world. I just recently, you know, got my residency. So you know, I've just been building up on my skills. I got my credit up. My wife has her credit up, and we've just been working, and I've been trying to build my skills into sort of being able to create, you know, sweat equity, also, you know, save up my money and things like that in order to make, you know, the proper investments. How would you recommend someone to step into this game?
That's a good question, Luis. What kind of residency are you in?
Residency? I'm a permanent resident.
Okay, awesome. Well, congratulations.
Thank you.
Yeah. So, you know, number one is when you step into real estate investing, when I first started, is I looked at what were my goals, right? I didn't know that one day until someone told me that my investments can actually cover expenses. If that is one of your goals as well, then we should hop on a call and look at what are the options that you have, and we'll go over all the options. You know, the goal of our discovery calls, when we do a discovery call, is not to sell you on the fact that, hey, multifamily is it. It's really to discover, is this the right vehicle for you? Some people may not be ready yet, but for some might be a little too late. You know, not too late, but it's like, wow, you've delayed it so long. You should have invested 5-10 years ago, right? So everyone's at a different stage. So if you've taken the information from the screen, let's hop on a call and we'll sit down and really dive into where you're at and how I could tell you how I got started, right? And then we can go from there.
Yeah, that'd be great.
One comment I would like to make, Louis, is you said late bloomer. It's never too late, okay? I know you're a pretty young guy and you're starting out a lot sooner than I did or Alex did. So it's never too late, okay? So I think everybody can bring different value to any real estate investment for that matter. So like Alex said, feel free to reach out to us, and more than happy to hop on a call and help you through.
Yeah, I appreciate that. Yeah, that's kind of like the reason why I chose to be a plumber. I've been going about to hit a year now, and I work for Benjamin Franklin in Batavia, and we service a lot of rental properties. And I just see like the type of damage that people cause, and especially in the sewage, you really can't control that. That's like something that's very costly when it comes to rental properties that I see a lot.
Which is why you need to have healthy reserves.
Yeah.
That's the importance of having good liquidity and good reserves. And that's something that we focus on, right? Having good repairs and maintenance reserves, having good CapEx reserves, having
Yeah.
good operational reserves, right? So for insurance purposes, for mortgage purposes. So we make sure that we have about 6 months of reserves on our properties, which means that if we have extremely high vacancy on our properties, we can still operate the property just using those reserves for 6 months, right?
Yeah.
If our cash flow even disappeared for 6 months. So I think all of these aspects are very important. So what you mentioned about plumbing repairs and stuff, trust me, we have seen nightmares.
Yeah.
Actually, on one of the properties we just stabilized, the 17 unit, we had plenty of plumbing nightmares. But once you're well capitalized, and if you have good reserves, you can plan for those types of expenditures, if you will.
Yeah, makes sense. Well, thank you guys. That was kind of the question I had, and I'll definitely be contacting you guys.
Thank you, Luis.
Absolutely.
Thank you.
Luis.
Kine, hello.
Hi, Alex.
Hi. Welcome.
Thank you. So what I'm curious about is about how many properties a year are you looking to invest in? Do you have something on the horizon? Is it in the Cincinnati market? And then how many partners, do you limit the number of limited partners? And how do limited partners evaluate the GPs?
That's a great question. So number one, to answer your question, the first question is how many properties are we acquiring every year? It's different year to year, right? We just looked at a property last month and went through due diligence and then figured out, ooh, something just wasn't right. And we went out of contract on that one. There's always properties down the pipeline, and market conditions, everything plays a role. So your second question is how many limited partners are in a property? If it's a 506B where it's friends and family, I believe that limit is around 30 to 36. Is that correct, Jay?
35.
35.
Technically, you can have more, but you can have 35 non-accredited investors with 506B. You can have more accredited investors beyond that. So yes, you're right, Alex. So 35 is the limit for friends and family non-accredited investors in a 506B, which we would typically use for a small to a mid-sized asset. If it's a larger asset, 200 units, for example, $20+ million, then it's going to be a huge capital requirement. So we will most likely go down the 506C route, which does not have any limit on how many investors or LPs we take in. But the only thing with 506C is every LP or passive investor has to be accredited. And what accredited means is, of course, consult your CPA on the definitions, but essentially what it means is you need to have a net worth of $1 million or above, excluding your personal residence, or you need to have an annual income of 400,000 and above. So that's usually that qualifies you to be accredited. So the number of investors truly depends on the size of the asset and the number and the total amount of raise. Usually the minimum investment per investor, our bottom dollar is $50,000 per investor. How many units was one of your questions. Again, we have no units target because we have seen a lot of mistakes made when people set their targets on, we have to acquire 1,000 doors this year. You end up buying 1,000 doors and deals that are of poor quality. So our main metric that we track is deal quality rather than door count, if you will. And I think your third question was how do we vet, how LPs or passive investors can vet the GPs, or how can they interview the GPs, if you will. So I think there's multiple factors, and I think that is a great question. I think there is one book that I would recommend you to read, which is Hands Off Investor, I believe is the book, and it's geared towards passive investors. It's written by Brian Burke of Praxis Capital. So essentially, there's multiple things, but primarily it's looking at the GPs and their backgrounds. What are their backgrounds? Looking at their current deals and how are they performing? Speaking with the investors who have invested. We are more than happy with, of course, our permit from the permission of our current investors. We are more than happy to share names and contact information of current investors. And you can talk to them that, hey, what is your experience working with Compounding Capital Group? How have their assets performed? Are these guys, how do they actually behave when things don't go according to the plan? And with every asset, there will be something that will not go according to the plan. Lately it's been leasing. Leasing has been very slow, so things like that. So I think that's my 2 cents. Alex, anything else to add on how would you vet GPs?
Yeah, you brought up great points where we're completely going back to our core value, transparency, where you're able to contact our current investors, talk to them, the ones that who allow it, right? Looking at and asking around, right? It's hard if you're not in the investor side to know who's good, but also looking at their past history, finding out when we tell you, hey, this is the property, go look it up. Look it up on Google Maps. Here's the thing. I've been pitched deals by operators where I look them up online and I'm like, these guys are not, where are your properties? This morning I went through one with another investor in South Carolina. She wanted to invest in this one deal. Her and I met, she's another doctor. And she's like, Alex, can you look at it with me? And I said, I can't find this guy online at all. And then we start diving in further into their properties. And I realized this gentleman was using stock photos.
Right.
And I could tell, I said, these photos are CGI, computer generated.
Huh.
Right. And that's, I said, there's too many red flags. I would ask more questions about it. And then
Right.
she says, maybe this is not the right one. I mean, transparency is huge.
How many,
Right.
how many general partners are there, and how many limited partners do you have?
Usually general partners stays around that 5 to 6 general
Okay.
partners maximum. And then limited partners, like Jay was saying, if it's a 506B where it's friends and families, depending on the size of the deal, it's 35 and under. If it's a 506C where say we need to raise $10 million, right? And then the minimum is at 100,000. Well, then we got about 100 people investing into it.
Yeah. Are you looking at those higher value properties, or do you guys have a range that you're looking for? Like you're looking 500 to 2 million properties, or what are you shooting for?
Jay, what are we seeing so far recently?
What are we shooting for? Our buy box? That's another good question. Our buy box is 50 to 200 units. That's what we are shooting for now. In class A or B areas. So what that means is, of course, school ratings and, for those who are not familiar, but crime ratings, average household income of at least 70K is what we look for. So A and B neighborhoods, and usually B or C assets. So that's the true definition of value add real estate. So we are looking for value add properties, 50 to 200 units in Cincinnati, Northern Kentucky, south of Dayton, certain suburbs of Dayton, but also open to Columbus and Indianapolis markets. So this tri-state area is what we focus on. And why we focus on this area is because this is where we have our operational strength. This is where we have our construction teams. And operations is everything, so.
Yeah, that's everything.
So that's how we.
The longer I've been in this, the more I realize how important that is.
Thank you.
Yeah, and answering Jay, kind of recap what Jay was saying, when he said A and B neighborhoods and B and C apartments, see, you never want to buy the best looking building on the block. Like if you're in a C neighborhood, you don't want to buy the A building, or you don't want to turn that C neighborhood and then your building becomes A because you've overdone it.
Right, you don't
Right?
have
You
any.
put, right, you can't push those rents. So you rather purchase a B building in an A neighborhood and then turn that into a A building. That's where the value add comes in.
Exactly. Good
Yeah.
point.
Did we answer all your questions?
You sure did. Thanks so much.
Awesome. Awesome.
Thank you, Kinetic.
Jason, you're next.
Hey, gents, thanks for this. I may have missed a slide or two because I stepped out, but for just a little bit there. But in terms of like lockup periods, do you guys manage those? What is the range on those for you guys?
Jason, first of all, thank you for joining and thanks for the question. Lockout period, did I hear that correctly?
Lockup periods, obviously a lot of capital funds, they lock up funds for a time to where if you're one of the investors, you can't clear those and release those at any point.
Right. So lockup period, that's a great question. So I think one of the very few shortcomings, if you will, I don't even think it's a shortcoming, but downside with real estate is it's an illiquid investment, right? So you cannot buy and sell assets like you can do with stocks and high frequency trading. So usually our lockup period is as long as we hold the asset, 5 to 7 years. Sometimes we sell it sooner, 3 years. So if we meet our projections sooner, we will sell the asset sooner. So, but that lockup period, the investor expectation that we set is 5 to 7 years. In very rare instances though, and I don't want to set this as an expectation, so I'm saying this with a caveat, in extremely rare circumstances, if there is a personal family emergency and the investor has to take their 50K out, and again, it also depends on the amount. So if someone wants to pull out $1 million they invested in, it's going to be hard for us to find replacement investors to replace their capital. But on a very case-by-case basis, if you need to get the 50K out, we can always help and work with you on perhaps finding another investor to replace the capital that you have invested, but that comes with a penalty. So some of the returns that we accumulated in those first 2 years, you will lose a portion of that because you're liquidating your portion. But
okay, so sidebar question to that, Jay. I appreciate that. So obviously, going into anything investing at any point, it's long game, right? So you're not looking to jump out of the plane anytime soon. But I guess the idea for me is, it sounded like individual investors are LPs are basically locked into one loan over one property. Is that the case? I mean, it seems like on the books they're assigned to one property. So if, we had an 80 unit, and I was to invest, that portion would be lumped into that unit, the performance of those units, that property itself. And then at that point, if you were to pull out of that, I would have a pretty easy ability to schedule and understand what's happening with that specific performance. Are there times where funds are pulled from communally and split off, particularly after the refi, where it becomes free money for everybody? Are there times when you can then crossfire and add to a process of becoming a portion of a different property purchase?
fantastic question. So yes, the answer is your funds are used for that specific asset. So you know exactly what's happening at that property and how that property is performing. If you make multiple investments across multiple different assets, you will almost always get different performance on your investments. So that would be a good way to diversify, where you invest in different offerings, but each investment will be in one asset. We don't do funds. So there is a funds model that
Okay.
some syndicators do. We purposely chose not to do the funds route because a lot
Smart.
of times what happens with funds is you get the money from investors and now you have this pressure to invest and find some property. So when
Right.
you have this investor and you're on a time clock to invest the funds, sometimes you don't make the best buying decisions.
$1,000
That's
doors.
why, yeah, that's why we don't do funds. But
Gotcha.
your second question about refi, and after we do a cash out refi, the return of capital happens and we will return that money back to the investors. Now, what the investors choose to do with that capital return is up to them. If we have another offering at the time, you can choose to reinvest with us, or you can just take that money and proceeds from refis are non-taxable. So that's a tax-free paycheck that you get essentially, and you can do whatever you want to do with that capital.
Perfect. Thank you much.
Thank you, Jason.
Thanks, Jason. Is there any of you have any other questions before we end the night here? If not, I want to thank everyone for attending. Jay, thank you for all the insights. And don't forget to get our information in. And of course, we hope to see you on the next webinar, which is June 26, 5 p.m. Pacific, 8 p.m. Eastern. Have a great night, everyone. Thank you so much.
Thank you all so much.